Great, so terrific, and we'll continue rolling here. And I would say, you know, last but absolutely never least, I'm so pleased that we were able to fit the schedules together for today. And, you know, we have with us today someone who's known well to many of you. Oh, sorry, if I can get my screen share going here. There we go. All right. Okay, the very magical Lindsay Stencel. So I've seen you in the screen here, the thumbnail. So I know you're here, Lindsay, which is awesome. We're perfectly on time. So thanks everybody for helping us getting back on track. As many of you know, Lindsay really drove us to become sort of the go-to seed investment source in upstate New York. And, you know, while this is something we had in mind, it was a tough thing to get off the ground. And I absolutely know that Launch New York could not have done it without Lindsay's effort with us as COO and fund manager at that time. As all things, when we've grown, it's turned into a beautiful next phase relationship for us. So Lindsay is primary legal counsel and a limited partner in our limited partner fund. And by the early reports that I was giving you in the opening session, the number of transactions already this year on the LP fund alone is 18 compared to 19 for all of 2019. So Lindsay is there with us every day, and I'm, you know, super thrilled that we were able to really turn this into beautiful music as everything is growing tremendously. So now Lindsay is partner for the Venture Capital and Emerging Companies Division for Thompson Hine. And again, so thrilled that, you know, she's been able to itch her expat, want to give back, want to stay engaged, working with Launch New York. So with that, I want to turn it over to Lindsay to talk about what's happening in seed and early stage investing and share some of the in the weeds information that only she has. So, Lindsay.
Well, thanks for having me. I'm going to try to do this as successfully as I can to share my screen. So let me know if you can't see it because I tend to screw this up pretty good.
We don't see it yet.
We're gonna keep moving forward.
Yeah,
hang on.
Hitting the share button is my issue. Once you
yeah
your screens, then pick the one you want and hit share at the bottom right.
All right, yeah. So this is the poor souls that got to hang out with me during my teaching at the Ohio State University over the course of the last year. They had some real struggles, I'm sure, putting up with some of this. So anyway, it's not really working. So I did build the presentation, but we're not gonna rock and roll with that. So I'm just gonna kind of walk through topically today. First of all, first and foremost, thanks so much for having me. It's a super honor to be here. We're gonna fix this a little bit too. Hang on one second, sit tight. Is this working now?
We don't see it yet, but if you want, you can stop. You can either email it over or you can stop screen share and we can just watch you.
Okay, let's do that. Hang on. Can you see me? Let me know if you can see me.
Not yet.
Sorry, guys. Told you I would screw this up. Just give me a second. I think I just have too many things probably open. Hang on.
Now we see you. Beautiful. We see you.
Okay, perfection. So I'm going to get started. First and foremost, you know, thanks so much for having me here today. I'm super honored and humbled, as always, to be back hanging out with my hometown team. You know, it's been a wild and winding road, and I couldn't be more excited and honored to continue to participate in all things Launch New York. So it's been a real blessing, and I'm super grateful to continue to participate. So couple of things for any of you who don't know me, street cred as to why the heck I actually know what I'm talking about. I'm an attorney in BC, so I'm a Buffalo expat. I graduated from Canisius College. I played a D1 sport there, had a blasty blast. And then naturally, I love the Buffalo Bills in an obsessive, crazy, pathetic sort of way. I also got a JD MBA from The Ohio State University, where I continue to teach budding legal eagles today, all about venture capital and deal making. So I was one of the first venture capital partners in the Midwest. I know that's a female. That seems like that shouldn't be happening in 2020, but until about 2018, I was really one of the only ones through an early stage venture fund out of Columbus. In 2016, I joined the wonderful team of Launch New York, and Marnie kind of ran through everything that we got to do together and continue to do today. So I'm honored to continue to do the legal work with my team that I lead in venture capital and emerging companies through Thompson Hine, which is not to market that, but a large law firm based in particularly the Midwest. And we have pretty audacious goals of being the Cooley of the Midwest from Albany to Omaha. So when I finally get to travel again, maybe we'll see each other. So you know, I am a limited partner. I am honored to be a limited partner and excited about the potential of the portfolio, and I love to see it continue to grow. You know, and I'm excited to. I didn't tell Marnie this yet, but it's a challenge to all of the other limited partners who are out there. I'll be increasing my commitment before the end of the closing period. So, you know, I challenge all the rest of you who are already invested or have not yet invested to do the same. I'm one of those people, I put my money where my mouth is, and I believe rising tides lift all ships. So let's do that together. So, you know, here I'm going to talk about today basically making upstate not the next Silicon Valley. So you're like, what are you saying, woman? And I fundamentally believe that we should always be our own selves, right? We should be who we are, and we are upstate New York, and that is okay. National trends have kind of proven that to us in some capacity, in some degree, and so I think that we should honor that a little bit. Seed stage investing is naturally very risky, and naturally COVID has impacted that, not just in the upstate New York area, but nationwide. And you know, some have really accelerated their businesses because of it, and some are struggling, but that's okay. You gritty, resilient entrepreneurs, you're adaptive. I know you're going to come through, and it's going to be great. And I have full faith and confidence in you. You know, a lot of VCs now post-COVID are really starting to think about, okay, how do they salvage their portfolio? The great thing about Launch New York is these companies are so early on in their business development and business modeling that this still remains a beautiful time to change where they are in terms of the path that they're headed down. So it's a great place to be because you're not married to one business model that you've sold to, you know, hundreds, if not thousands of investors. And then you got to like figure out how to change that. And sometimes that works great and sometimes it doesn't. When you're in seed, it definitely still works, and pivots happen all the time. In terms of trends, you know, I think a lot of the companies, I know we talked about a little bit at the onset, the companies here we do have a lot of great sectors, and a lot of these sectors are things that are going to be carrying us on and forward into, you know, the brave new world, if you want to think about it that way. So, you know, it's one of those things to kind of, as we think about the portfolio, and I still say we because I am pretty passionate about the things that we've all built together, but, you know, we think about, okay, you know, how do we change what the workforce is doing? How do we change food delivery? How do we change delivery of medicine? How do we, you know, improve telemedicine? All of those things are going to shape the world from here on out. And it's a pretty wild thing to think about, but we're pretty well situated to do that with all of the research and great support systems that I know George and some others had referred to earlier. And, you know, I think it's just important to say that in terms of upstate New York and emerging markets, we're seeing a lot of influx and flood now into these more emerging markets because turns out the coasts don't always have the most. And so there is an opportunity from not being coastal. Yes, 97% of capital traditionally sits on the coasts. But if anyone has paid attention to anything in the last 90 days, the coasts haven't fared too well during these COVID times. But let's not be fooled there. This is something that was coming anyway, and I think COVID accelerated the inevitable. Opinions by outcasts. COVID wasn't really the only factor moving people, to new marketplaces. The cost of living on the coast is too high. It's wildly expensive to run a business. People are finding now that they want green space. That's a little bit of a function of COVID, because like when you live on top of each other, it's a little challenging. And just generally speaking, cost of living and cost of running your business, you can do twice as much for half the price. So if you want to hire a developer in Palo Alto, that's cool. That's going to cost you 300 grand. You can get 3 or 4 of those in upstate New York and keep moving the ball forward. So I think one of the things that we should always be thinking about is, how do we maximize the opportunity in seed? Yeah, seed is risky. It's incredibly risky, but one of the things that we do really well in upstate New York and the Midwest is we think about unit economics more significantly, maybe than some of our more bullish counterparts on the coast. We really want to fundamentally understand, what do unit economics look like, and what are the returns looking like, and not just returns in terms of, and I'm not saying returns in terms of, oh, well, what does the next raise look like? Some people are always like, always be raising, always be raising. That's not really what we do here in upstate in the Midwest. You have to think about having appropriate cash reserves for your business, but I don't think you need to constantly raise to pay off the previous people, because I don't think at the end of the day that works super, super well. See generally companies like WeWork or We Won't Work, whatever you want to call it. It hasn't been going super swimmingly, and I can keep, going with a laundry list more of those. We think about risk mitigation a little bit differently in upstate New York and in the Midwest. Our valuations tend to be lower generally, not always, at the time of investment, but a lot of times our returns on capital, our multiples of capital, MOC, does tend to statistically be a little bit higher. And I think there's just lots of untapped opportunity. When a region gets ignored for an extended period of time, and doesn't get the love that it deserves, there's always opportunity for some folks to do some really amazing things. And who doesn't love a good underdog story, right? So I'm sure, companies don't get the benefit of tons of available capital on the coast. So, but that does cause them to behave a little bit differently. It tends to cause them to be scrappier and a little bit more cost conscious, and not just hiring for the sake of hiring, and raising additional capital at all costs. So the next 12 months, things to be thinking about, whether you're an investor or a company, cash is going to continue to be king. Capital is a scarcity, so a lot of VCs are really focusing on portfolio protection and seeing what they can salvage and what hasn't, totally fallen apart. They're going to try to make sure that they maximize those opportunities. But newer formed VCs, Seed Launch New York, Seed Fund One, they have plenty of capital to deploy. So it's a unique opportunity for those folks. When you have capital, you get to you just get to pick better deals. You get you get more opportunities, and more at bats typically produces more likelihood of return statistically, like I think a few folks have already said here today. So and now is a great time if you do have new available capital, because you can invest in some of these post-COVID world new industries that are morphing and shaping and developing. So, it's just a really exciting time. So cash is king, and the time to invest is now. The last recession that we had produced some of the biggest unicorns that we've seen in a very, very long time. And typically those patterns repeat themselves. So I challenge you to think about that. Series A valuations are in the process of resetting to some degree. So we are starting to see those values come down a little bit. And so I think that the opportunities that present themselves for investment are even more attractive. And the market is shifting a little bit more to investor favorable terms. So why not get in now when you can benefit from, this whole COVID crises? And I will also caveat this. I do a ton of fund work. I have, I don't know, nearly 100 venture fund clients that I do work for, from Palo Alto to New York City. And I will tell you that niche funds are something that are just really popping up. And so I think there's something to that, and to taking note and paying attention to that. Niche funds are acutely focused on, things like geography, such as Launch New York, for example, gender, maybe race, sexual orientation. I just helped launch an LGBTQ focused fund last week. There's a women focused fund closing this week that I do work with. I did work with the largest Black owned venture fund to ever be formed in the United States. So they got up and running last week. But I think that's the wave of the future, focus on a core series of tenants, and get capital into some of these underserved markets that maybe haven't gotten as much love as maybe they should have. So the opportunity really is now. Smaller funds, I do think they provide more hands-on ability to interact and affect change for the companies that you're investing with. So one of the nice things about Launch is, we're here today in Walkabout, and you get the opportunity to meet some of these companies, see if you can add value. Maybe you can connect them with their next customer, their next client, their next new hire that they might be needing. So all things for you to consider in terms of driving value and adding value. So I will say, then I will wrap it up and I will say, what questions do you have? And thank you for having me.
Thank you, Lindsay. And I obviously am incredibly humbled and, I guess like Mel, a little teary-eyed over the idea of, your commitment just shines through. And so thank you so much for everything you've done and what you're continuing to do. And you're just staying on top of what is happening. And, that's exactly what we need here, because it's easy to just put our head in the sand and kind of do it the same old way. So want to thank you first for that. I do want to open up the floor to questions. Lindsay's got, just a wealth of knowledge, and she's a transaction maniac. So
yeah. Yes, we do a lot of deals. A lot of fund formation and a lot of deals.
My favorite stat was over 1,200 transactions. So that's a lot of transactions. I'm actually going to throw out one for you, because it keeps coming up more and more. And I don't know with COVID if it'll change, but everybody and their brother wants to do a safe. And at Launch New York, we use a convertible debt note until somebody moves to a Series A, of course. But the safe keeps coming up more and more. And I guess I'm just curious, what trend do you think we might see there?
So the SAFE, so Simple Agreement for Future Equity, is effectively, if you want to think about it like a warrant to purchase equity at a future time in the next round. It is very cheap and easy for a company to document, so that's why they tend to like them. It also tends to be much more entrepreneurial friendly and favorable, because it doesn't have the hand tying and bells and whistles that you might see in a convertible note. And so naturally, an entrepreneur is going to say, please give me that. I like that. I don't like a lot of rules, please. And I have seen a lot of companies try to run at a safe round in the last 90 days because it was just more cost effective for them to do. I will say I've only really seen, just for order of magnitude, I do typically 2 to 3 deals a week. So in order of magnitude, I've seen 5 safe rounds close. I've seen a couple larger equity rounds close. And then predominantly in the early stages when risk is higher, I've seen companies actually shift out of the safe, or I've seen them just start with the convertible debt instrument because it tends to be much more in what the investors are asking for right now. We've seen, because of COVID and cash becoming something that investors are sort of holding a little bit more closely and they're being less fast and loose with, we see a lot of investors say, I like your deal, but I would kind of like a little bit more protection around this. I'd like a little bit more, and the interest rates aren't high, right? They're still like 6 to 8% ish. So you're not making a ton of money, but they'd like the time value of money plus the discount cap, maybe a combination of both. I'm not going to say you don't ever see safes. It's just right now, a lot of terms in deals, just generally speaking, are moving to a more investor favorable deal set. It's not going all the way 2008 deal set, but it's because that was like real crazy, but it's more certainly investor favorable than it was a year ago.
Interesting. Yeah, those West Coast trends, it's like a new haircut. We seem to have to go through it one way or the other.
And it's sort of funny how you watch it like roll across the country very slowly too, you know, and really in the first few weeks of the COVID stuff, you started to see some of the West Coast folks raise their hand and be like, whoa, not sure about this deal. I'm going to maybe take a participating preferred here, or, you know, something weird started to kind of pop up and you're like, so that's how you kind of knew there was something brewing.
Absolutely. Okay, well, one last shot, everybody. Lindsay has wrapped it up beautifully, as she always does.